Do you need a better way to manage your money? In this Financial Soup du Jour video, we're going to explore the three main ways that we use money. We're going to give you a simple way to manage debt. We're going to manage current expenses and how to plan for the future. Now, all this can be fitted on a one-pager Excel spreadsheet. And what's also pretty neat is that this spreadsheet will actually give you a cash flow analysis, which we can make our decisions visually and mathematically see what's going on. And it also gives you a net worth statement. And we'll provide this spreadsheet to those who request it. Hi, I'm Mike Bogdan. It's August 2025 and I'm here in Pittsburgh, Pennsylvania. I create these educational videos with the Nest Egg Financial Group's social media outlet called Financial Soup. As with all these presentations, feel free to like, subscribe, comment, request a download, or chat with me. Now, we're not going to be using Chat-GPT. We're going to use Chat-MRB, since MRB, those are my initials. So use the link in the description below or the QR code at the end of this video. Now, why watch this video to the end? Every video that you see, it says, hey, make sure you watch to the end. We'll give you a free gift or some secret will be revealed. YouTube wants retention. They want eyeballs on the video, and that's one of the quantifiers they use to say, hey, the content's good, or at least people are interested. So since YouTube likes retention, and retention will promote distribution. And distribution, in this case, can educate more viewers by distributing this content to more people. So since this educational video should be seen by more people, you can help educate, you can help indirectly educate others by simply viewing this video to the end, and the good folks at YouTube will do the rest for us. So with that being said, let's pivot on over and actually start working on the spreadsheet with a couple cases, okay? All right, so here we are on the cash flow analysis spreadsheet that we're going to use an example here. And this is pretty simple. What I do here is I have the three main ways that we use money in these columns here. We use it for past purchases. Those are the things that we purchased that we have yet to pay for. Present services are for things that we buy monthly that have no asset value. They're just services like gas, water, electric, phone bills. And future purchases are the assets that we're saving for future use. Residents that will have a borrowing capability off of collateral or sale, a retirement, college planning, things of that nature. So what I did here is I simply no longer using this as the fourth dimension here of tax planning. We're just going to do a simple yearly net income for a household, divide that by 12 to get a monthly income, and see where that monthly income goes into these three columns, or these three main ways: past purchases, present services, and future purchases. Now, my apologies to the accountants in the group. I'm not a debit credit trainer at this point. I'm just going to say all the payments are going to be positive for this simplistic example here that we're going to be going through. So for the past purchases, we're going to simply list them all here, put all the payments as a positive number, and put all the balances as a negative number here on how much is left as a liability. So here we'll actually add up all the cash flow, 2,800 in this simple example, and over here we'll add up all the remaining balances and put it down here. And we'll take a look at present services, what we're paying, put that number here, add them all up. And future purchases, what we're paying above and beyond discretionary before the 401ks and everything else. Again, we're talking about net cash flow just as a rough estimate to see how this household is doing or how you are doing personally here. So we'll add up all the payments, we'll add up all the payments, we'll add up all the deposits and payments, then we'll add them all up here, and then we'll subtract it from your monthly to give you a net cash flow per month. And then, as I said before, we'll take the assets minus liabilities and give you a net worth. So a one-pager, very simple to see what's going on in a household. Now, as I mentioned in other videos, that there's always a guide for that, and we do have a guide for that, and you simply can request it. It's called the What Issues Should I Consider When Starting Out Financially? There's threshold issues about understanding the basics, cash flow issues, tax issues, and a whole bunch of other things. Again, this form or this PDF can be yours simply by requesting it. So now let's go over to the actual example for a little deeper explanation of what's going on here. So here we are with an example here, and we're going to have a 120,000 net income into the house, and this is net income. And I'm not taking a look at pre-tax contributions into 401ks or 403bs. So let's take a look at past purchases. You bought a house a couple of years ago. You owe $300,000 on it. You're paying $2,800 a month. Credit card, $300, $500, $8,000, $6,500. A couple student loans and a car. So the total amount of debt here is $413,000. The spreadsheet simply adds these up, gives me that. And the total amount of payments to debt is $5,525. Now, there's a couple things here. The credit cards should never let this happen, but when you have a cash flow of just basically zero, you know for sure that you're using this and thinking, well, I could pay for that later, pay for that later, pay for that later. Credit cards typically now are at 20, 22%, 24%. So one of the things you must do is you must find a way to pay off high interest debt. And paying off high interest debt is hopefully having a good credit score and finding some lower interest credit cards to do balance transfers, or maybe you have a home equity option. There is home equity lines of credit, there's loans, and there's cash out refinances that you can do. And if you need more information on that, guess what? We have a guide for that, so that's also available. So what you got to do here is you got to pay off high interest debt. Anything over 7 or 8% you got to pay off, and you got to take a look at managing student loans. And also on these student loans, there's something called the income-driven repayment plan, and there's a couple guides for this too that are available for you. 2025, what issues should I consider when paying off my student loans? And another guide, am I eligible for an IDR plan, the income-driven replacement plan for my federal student loans? So 3 good guides here for you on how to manage debt. Now let's go over to present services. All right, continue on with the cash flow analysis. We're going to go over to present services. Now, present services are those things that's pay as you go. Water, electric, gas, fuel, sewer, lawn care, homeowners if you have. So take a look at your most recent checking account statement. Put them all down here and see what you got. The sleepers are subscriptions, because they'll show up on different credit cards across the board. What you have to do in this column here is knock it down to the bare bones so that any extra cash flow can pop over and get rid of this. So once this extra cash flow pops over and gets rid of this, you can then take your extra cash flow and pop over and give it to this. Now, most people do things backwards. They save what's left after spending everything. What you have to do is come up with a saving budget and then spend subsequently. Okay, so if you need to save $1,000 or $2,000 a month, that should be priority number 1. It should not be whatever's left over. Because if you take a look in this case here, what's left over is $35 a month. You're not going to get rich on $35 a month. You're not going to fund a retirement or college education at $35 a month. So this is the rough one here, the present services. Another indication here of the present services isn't well managed is that typically the credit cards start popping up. So by managing this, trimming this down, you should have some better cash flow. It's going to take a while, maybe 2, 3, 4, 5 years, but happiness is a positive cash flow, ostensibly a lot more than $35. So what do? Get rid of subscriptions, stop going out for dinner, or at least go out once, not every 3 or 4 days per month. Saying no to extras. Every time you go somewhere, would you like fries with that? Well, even French fries now cost several bucks. So anyway, manage the present services here. Trim it down. And then use that extra money to get rid of this. And then when if you get rid of this, for example, if you just get rid of these, several $1,000s can go over here. So very, very important. So the guide for this is get out of debt, manage this, at least for the short term, down to bare bones. Okay, and a couple other considerations we should talk about is a 1-month cash reserve and a 6-month cash reserve. And also, since we have a lot of guides to give out, there is a guide for this one too. It's called What Issues Should I Consider When Reviewing Cash Flow? What debts are you currently repaying? How to repay them? Do you need to have a review of your financial goals? Do you need to earn additional income? How to quantify your fixed expenses, how to quantify your variable expenses, unexpected expenses. Very nice checklist on what you should do for this present services column. So anyway, again, this is available for asking via email, and now we'll continue on to the future purchases like retirement, tuitions, things of that nature. And of course, one of the most important future purchases we have is basically purchasing our own retirement. So with that being said, I mean, we had to fill this column or this way of money use pretty heavily over the years. For example, here, most people don't know how to adequately address this. What we do is we simply do a quick calculation here. If we have a 35-year-old who's going to retire at 65 and expire at age 94, and $120,000 of current income and $350 of current savings in a retirement plan or whatever. Again, these are just ballpark figures to give you an idea of what scope of goal you need to save. So if we do inflation of 120 at 2.5% per year over 30 years, $251,000 per year is going to be equivalent to $120,000. Actually, it's going to have to be more than that because of the progressive tax rates, but let's just use this number as an example here. So if you want $251 at retirement, okay, and if that's going to, the nest egg is going to earn 6% and last you 30 years, and you're going to have $2 left over, you need roughly $3.5 million at retirement at age 65 to bleed down to $2 with these very simple assumptions, ballpark figures again. So what do you need to get $3.5 million if it earns at 6%? No volatility. Again, a rate of return will have some wobble or wiggle room in it, but we're just doing a straight, simple calculation here. $350 saved, 30 years. Yearly savings goal is $18,300. You need to be putting $18,300 away a year, or roughly $1,500 a month. So that's why it's important, again, to trim this puppy out here, get rid of this here, and put that $1,800 or whatever it is over here and start managing it. Now this is a simplified calculation just to give you a ballpark figure of going forward what you need to do. So what we do as financial planners, I don't want to say there's a guide for that, but there's a spreadsheet for that. If you want to get a quick 30-minute discussion about what your number should be, there's a lot more going on beyond that point in terms of Roth IRAs, 403Bs, 401Ks. But definitely the thing you should do on any type of retirement plan is make sure you contribute up to the match. The match is free money. If the company is giving you a match dollar for dollar up to a certain percent, definitely do that. It's a great way to start in going forward. And then you have to look at the types of investments and the goals and the time horizons, and getting into the investment mode is not intended in this quick calculation going forward. So that's the three ways that we use money. Past purchases, where you buy something but you didn't have the money, so you're going to finance it. Present services, where you actually are using dollar for dollar current to pay for services. And the future purchases, where, well, retirement so far in advance will take care of it then. Now, it's the best thing to get it taken care of now, because continuous compounding makes a big difference later on when you have a large amount of money compounding versus a little bit. So with that being said, there will be a QR code at the end of this presentation. These guides will be available for download with an email request. And if you want to do a Chat-MRB, that'll be available too, to have maybe a 30-minute chat or an email conversation. So that's the crux of it, and hopefully this will set you straight, or at least give you some ideas on how to get going forward. Okay, thanks.